Interest rates represent the cost of borrowing money or the return on invested funds. Here's how they work. 1. Borrowing money. When individuals or entities borrow money from a lender, such as a bank or financial institution, they typically pay interest on the borrowed amount. The interest rate is expressed as a percentage of the principal amount borrowed, and it determines the total amount the borrower must repay in addition to the principal. 2. Factors influencing interest rates. Central bank policy. Central banks, such as the Federal Reserve in the United States, set benchmark interest rates, such as the federal funds rate. These rates influence the interest rates charged by commercial banks and other lenders. Economic conditions. Interest rates often reflect broader economic conditions. During periods of economic growth, central banks may raise interest rates to prevent inflation. Conversely, during economic downturns, they may lower rates to stimulate borrowing and spending. Inflation expectations. Lenders typically adjust interest rates to account for expected inflation. Higher inflation expectations may lead to higher interest rates to compensate lenders for the diminished purchasing power of future repayments. Credit risk. Borrowers with higher credit risk, such as those with lower credit scores or weaker financial profiles, may be charged higher interest rates to compensate lenders for the increased risk of default. 3. Types of interest rates. Fixed interest rates. The interest rate remains constant for the entire duration of the loan or investment. Variable interest rates. The interest rate fluctuates over time based on changes in benchmark rates or other specified factors. Nominal interest rates, the stated interest rate before adjusting for inflation. Real interest rates, the nominal interest rate adjusted for inflation, representing the actual purchasing power gained or lost from an investment or loan. 4. Investing funds. When individuals or entities deposit funds in interest-bearing accounts or invest in interest-bearing assets such as bonds, they earn interest on their investments. The interest rate represents the return on their investment and may vary depending on factors such as the term of the investment and prevailing market conditions. Overall, interest rates play a crucial role in the functioning of financial markets, influencing borrowing and lending decisions, investment choices, and overall economic activity.